thank you, Bob. I want to thank everyone for giving me this opportunity to get in front of the group today and just take a few minutes and talk about some of the key financial ratios that businesses use as they're looking at managing their business and moving forward, looking at profitability and so forth. With this, Bob had also talked about it's so key that we look at this with each generation involved here. As we go forward, farms are continuing to look at succession, moving the business from one generation to the next. And with that, each generation has distinct attitudes and behaviors, expectation, habits, and motivational buttons. And so we need to provide a platform, some way that the successors can better understand the business. And so what the goal and the key was today is to try and provide you with some of those key information pieces that businesses can look at to evaluate, the successors can look at, and everybody can make accurate decisions on where their business is going. So as we look at a family business, basically it always starts out in one of these four quadrants. You can have financial success, and you can also have people success. But there's, and the goal is to always be in quadrant one, where we have people that are happy, and we're also financially happy. But there's always forces at action trying to move us out of that quadrant. Now you'll see businesses at times that are in quadrant three, where the people are still happy but they're lacking that financial success. Well, people can be in that quadrant for a while, but without work and change, there will be no success in the business. We eventually move to quadrant 4, or it will liquidate. There's also businesses that are in quadrant 2, where they're financially healthy, but the people are unhappy. Again, we need to work with those types of businesses, trying to move them to quadrant 1, because financial health only keeps you happy so long. And if the people are not happy, eventually the financial success will start to deteriorate also. And then businesses in quadrant 4, it's impossible to make a transition there, where we have neither people happiness or financial success. So our goal is here to always continue to move people, work with people to keep them in quadrant 1. Excuse me. So financial analysis and ratios. Why do we do it? What's in it for us? It's basically a communication platform for you and your partners to use with owners, managers, successors, to help the stakeholders gain a better understanding of the business and create solutions for the future. We really need this so everybody knows where they're at, where the business is going, so there's not misinterpretation. We see that all too often when we're working with businesses. Generation 1, the senior generation, has a firm understanding of the business. Generation 2 may have an incomplete understanding of the business, and with that causes challenges, and we get to the point where there's people are unhappy. There may be spouses that are unhappy because of uncertainty, so forth. So again, we want to provide those ratios that make it clear. So the focus that I had today then is just basically broke up into 3 different areas. Why the importance of strong financial records, how do we measure the financial performance of the business, and how do we use these numbers to plan for the future. So the first thing when we look at the business, here's the big questions. Do you control the business, or does the business control you? And who is pulling the strings? When we look at this, I know first we always think of the financial side of things. Yes, there can be people that are controlling you from a financial side, but there also can be things that are going on from the people side. So again, look at your business. Can you get away from your business? And are you afraid when you get away? Or do you have the controls and measures in place so that you can be away, enjoy your time, and come back and know that things are running just as smooth as the day you had left? That's what we're after here. These are the control measures that we want to get in place. So when we look at the financial analysis and ratios, the two questions that we ask, number one, do you know where you're at financially? And do you have financial control of the business? Is where that really leads down to. So with that, we start out looking at this iceberg here. You know, and on the surface, things can appear great and terrific. But do we really know what's going on below the surface? Everybody knows about their herd size. Everybody knows about their checkbook. Everybody knows about how many acres of land they're running or the bushels of corn they're getting. But do we have financial measures in place? Do we have things in place here so that we can steer the ship accordingly and avoid turmoil, avoid big mistakes? Are we prepared ahead of time? Or are we running down the road or running through the sea just like the Titanic, and by the time we make the correction, it's way too late? We want to help you today. We want to provide you some information so that we can make decisions early, feel confident in the decisions that we're making to avoid those icebergs. So one of those key financial ratios that we recommend that businesses look at is liquidity. And the definition of liquidity is to measure the business's ability to convert assets into cash quickly without discounts. So what it is, it's your current assets minus your current liabilities divided by your total revenue. You may hear it called working capital. You may have it for different industries, that there's different standards, but really it's what is that ability of that business to convert things to cash quickly, timely, and meet their obligations as necessary. So we hear working capital when we talk about the dairy industry. We hear about working capital per cow. If we're talking about the grain industry, you may hear working capital per acre. But on the general, we look at it as, you know, that working capital divided by total revenue, and there are goal and targets to be greater than 15% of our gross revenue generated each and every year. The second key ratio that we look at is solvency. And here it's a measure of the business's abilities to meet long-term obligations and bear risk. We call it, in layman's terms, owner equity. Again, when we're looking at this from a market standpoint, we'd like to be above 40%. Now, one of the keys with owner equity, again, as we look at that, is not just to look at the market value and the 40%, but also how much of that equity, owner equity, is earned equity versus inflationary equity. Make sure your business understands how that equity was obtained. When I say inflationary equity, I'm talking about those balance sheet values that changed on that land. The land you purchased now is worth X. 5 years ago, it was worth probably 1/3 of X. So that 2/3 growth in equity there is not earned equity. It's inflationary equity. We need to understand true equity growth, true solvency improvement comes from earnings, comes from profitability. And profitability is a measure of the business's ability to generate earnings. So here what we're looking at is we're looking at that net income before depreciation and taxes divided by our total revenue. And again, our target there is to be above 10%. True earnings, not inflationary, keeping land values constant, keeping feed values constant, keeping cattle values constant. What type of profitability does our business truly have? Operating efficiency. It's a definition of how we measure the business's ability to generate sales revenue while controlling expenses. So again, you're looking at the net income before depreciation, taxes, but now we're also taking out interest and rent divided by our total revenue. So we're taking out the leverage portion of the business and just checking on what that operational efficiency is of the business. If this business had no debt today, how would it do? Does it operate efficiently, or is it a poor profitability, so forth, a result of leverage? We need to understand that, and our target here is to be about 35% for an operational efficiency. Capital efficiency. Anybody that's ever worked with me knows that this is one of my pet peeves. I'm going out and spending more money on capital. How do we generate revenue from capital? Can we efficiently do that? We see way too many businesses that want to spend more money on capital without a huge improvement in revenue. So when we look at the capital efficiency, I'm really looking at total revenue divided by total debt, and how are we using that capital? Again, our target there, when we look at the overall capital, is that we're generating a minimum of 75 cents of revenue per dollar of total debt that's out there. So using the capital efficiency efficiently. On debt repayment, we all know this when it comes to the checkbook. We've got to service the debts that we have out there. And so again, here's our ability to generate revenue to meet those obligations. So again, simple definitions. It's the funds available after paying all of our operating costs divided by the scheduled capital and term debt payments that we have. The goal there is to be above 1.2 or 120%. For every dollar of debt that's due in the next year, we should have $1.20 of available cash or cash equivalents. Do we have that? We need to be looking at all these ratios. Then the last ratio that we look at is growth. And there's not a definition here, but what we're looking at here is as we grow the business, as the asset base grows, if that grows by 5% a year or 10% a year, how does the revenue stream grow? Are we keeping up? Are they staying parallel? Are they getting closer? Are they getting wider apart? We need to make sure that the revenue growth exceeds the capital growth. If it's not exceeding, we're on a dead course here. So when we look at that, we know every year is different. We know there's years that are great. We know where corn prices are this year. We know where milk prices were in 2009. We know where milk prices are going to be in 2012. So we look at more than 1 year. We look at trends. What we have illustrated here is a 5-year trend to look at those ratios, and then we code them red, yellow, green. So we can see how does that business doing? What is the overall trend line? In this example that we have here, liquidity has been a general trending issue for this operation, and something that needs to be looked at to continue improving the financial health and move them into the Q1 that we described earlier. So, but we'll get businesses that we'll bring in and we'll be looking, analyzing the financials, and they want to do succession, and we'll see half of the scorecard covered in red. It's hard to plan for a succession when that financial health isn't here. Let's not lead the successor generation into a dead-end position. So are we leaning green or dead and red? You know, do we understand where we were? Do we understand where we're going? Do we know? How quick do we know? When do we detect trouble? Are we planning ahead? Do we know that trouble is coming, trying to make course corrections? Or do we find out when it's too late? And we're at the mercy of whatever comes along. This is not a fun situation to be in. So how do we do this? Starts out with budgeting and knowing your numbers. Preparing. Where is the business going? Budgeting is great. Budgeting is for you as owners of your business. Budgeting is not for your lender. We need to budget so we know where the business is going, but then we also need to monitor how the business is doing as compared to the budget. Along with doing that, how do you compare with your peers? You need to do some benchmarking. If I'm in the dairy business and my cost of production is $20 a hundredweight, is that a good number or a bad number? Yeah, I may have a bunch of numbers in between that are different than my neighbors, but if my overall cost of production is 20 and all my neighbors are the benchmark average that I compare with for this area of the country is $17, I've got a problem. And I've got to dig in deeper as to why that problem is occurring and how do we correct that problem. So how do we get there? What do we need to do? We need to have solid financial information systems. So it starts out by having systems in place that both create cash and accrual records. We need records beyond tax. Every farmer that I know does everything he can to minimize income tax. And yet, minimizing income tax cannot be the way that we look at our businesses to check on its success. I've known a lot of businesses that have went broke paying interest. I haven't known any businesses going broke paying taxes. I'm not saying to pay more than what you need to, but we need to understand. We need to have budgets developed, monitor those budgets. We need to know where our pro forma statements are going. What does our pro forma balance sheet look like if we do a change, modernization, and so forth? We need to be able to evaluate these ratios that I just went through. Now again, for your individual industry, some of them may be a little bit different, but it's still going to work back to those key liquidity, solvency, so forth there. And we need to develop those trend reports. So you can see, where were we last year? Where were we the year before? And where are we going this year? So the takeaways that I leave for you, that financial communication platform is so important. It allows you to communicate to your partners, to the successor generation, where your business is going, to not leave with a mixed message, so that everybody has full understanding. You need to have financial controls that are in place that add value. What are we doing? Why are we doing it? How do these things, are we measuring them the way they should be? And we need to have systems in place that allow for timely reaction. Putting a budget together and monitoring at year end isn't worth anything more than that piece of paper was put on. We need to be monitoring on a regular basis so we can make corrective actions if necessary and know where the business is going. So the one ad I have to put in here is, what does Lookout Ridge Consulting offer? We're dedicated to 3 different things. We're dedicated to practical solutions that address your business opportunities and challenges. We work with the financial health of your business and the well-being of your family. So with that, thank you.